Hi, I'm Bert Nussbaumer from macrobeat.co.uk. A sort of quiet week until obviously last night's Fed's Powell Q&A with the Wall Street Journal Job Summit. It feels the market spoofed itself a little bit, as I think because that sort of Q&A session was just sort of added to the diary from Powell just 2 days before the Fed blackout period ahead of the next FOMC meeting. I think the market suddenly felt like that Fed Powell may use that sort of Q&A to start to maybe send some messages about the big moves in US yields on the top side. Some market participant went as far as talking about Operation Twist. And I think, as I said, we know Powell now for quite a few years. He's very pragmatic. He sticks to the script. And he just repeated what he's been saying for the last few weeks, including what all the Fed speakers recently said. So the people expecting something different, as I said, I think the market just spoofed itself a little bit. But as a result, with him even mentioning the word inflation, even though obviously he mentioned it in his usual transitory sense, was enough to send shockwaves through the market. We've seen a big drop in bonds, so higher yields. We saw a big drop in equities. So the market was really set alight as they still feel the Fed is probably behind the curve, which I think the jury is still out on that one. I still believe, or I wouldn't be surprised that the Fed secretly is maybe quite happy what the market is doing. The market is doing its job right now, buying them maybe another 1 or 2 or 3 months time to look at the data. The reality is the two key mandate components, unemployment and CPI, are definitely still not yet checking the boxes from the Fed. Yes, I agree. It could be a moment where the Fed may start to get a bit behind the curve. But I think it's too early to say. Today, non-farm payrolls, which obviously the stakes just got raised from last night, a very strong number, and we could see another sort of similar move that we've seen last night with another big drop in bonds. If we get a weak number today, I think the first round, or this round at least, goes towards Mr. Powell. If we get a strong number, it could be the first round for the market, but I don't think we are anywhere near that we could say who is going to win the battle here. In terms of the charts that I have for you today, we want to concentrate on a few key areas as we are at big breaking points everywhere. Euro dollar moved down to 119.45. That is the area we looked at last time. This is the division between correction from 123.5 or actually trend change. With the DXY now near 92, it could indeed be a sort of big trend change, and a break here would actually mean that the dollar bears really have to start to acknowledge a move in the dollar. On the next slide, or the next two, we have dollar yen first. Obviously, we have two sort of themes with this backup on global yields. We see yen selling and we see Swiss selling. So this is dollar yen, big move up here in this week, taking out really every level. Next week, I'll probably show the weekly chart. There's a big trend line coming in, 109.10, which is really a 6-year trend line. So if this move continues, we get into the real nitty-gritty in dollar yen as well. The next chart, this is dollar Swiss, big Swiss outflows in the last sort of week or two, driven by higher global yields. So we see dollar Swiss taking out the sort of double top from last October. We sort of stretching towards the 93.20 Fibonacci area. And really, if the yield story continues as it is, there is no end in sight to the dollar pushing higher, definitely versus Swiss in the end, but most probably more in a broader space. But yes, the move is quite big. Yes, it's very steep. There's obviously a bit of give back at some point, but the overall theme, I just don't see changing right now, unless, as I said, you're going to get a real disaster on non-farm payroll today, which will probably see quite a drop in yields. Last but not least, with the next two, gold. Gold has reached that really big level. You may remember we talked about the 1763.5, that we don't trust it anymore. This area has to hold. If gold doesn't hold at 1680, then it's going to get really, really nasty there. And last here, the S&P, we've taken out the 2020 line with a break of 3805. As long as we stay below there and the 3780 level, there's a bigger risk to head as low as 3650 or even towards 3500. So a very critical moment for equities here. Thank you very much indeed. Bye-bye.